Good day and welcome to another Mr. James Accounting tutorial. Today we want to look at the net present value method in capital budgeting. First, you have to make two assumptions. The two assumptions are usually made at the beginning of the whole method. All cash flows other than the initial investment occur at the end of the period. Okay, so your initial investment will take place at the beginning of the period, and all the other cash flows, that is the money that comes in, is done at the end of the period. That is an assumption. So all cash flows generated by an investment project are immediately reinvested at a rate of return equal to the discount rate. Okay, so those are your two assumptions. The net present value method, this is how it operates. To determine net present value, we calculate the present value of all cash inflows, calculate the present value of all cash outflows, subtract the present value of the outflows from the present value of the inflows, and you will get the net present value. And okay, the net present value itself, the discount rate, the hurdle rate, or required rate of return. Okay, all these are three are the same thing. Required minimum rate of return given riskiness of investments. Okay, so the discount rate is the required minimum rate of return given riskiness of the investment. We don't really look at riskiness at the CAPE level, so you needn't bother about this part here. The proposal is acceptable when NPV is greater than or equal to 0. So let's take a look at how we use that net present value method to make business decisions. Okay, the net present value method, the example. This is a bit blurry there. I took it off a textbook. All right, not, I'll read out what it has there. All right, the present value of the annuity is 1,048, 1,648 and 410, less the initial investment of 1 million, and we get a positive net present value. All right, so what they are doing there is they're taking the present value of all the inflows, and then the minusing the present value of the initial investment, that is the outflows, and you get a net present value here. Now, if this figure is negative, you will not accept the project. Okay, so the decision, we have it down here. If net present value is positive, invest. If net present value is negative, do not invest. It's as simple as that. Okay. So what we will want to do is look at how we calculate the net present value. Right. We have the thing sum up here in a bigger. If the net present value is positive, it is acceptable because it promises a greater return than the required rate of return. If it is 0, it is acceptable also because it promises a return equal to the required rate of return or the discount rate, right? Negative, then not acceptable because it promises a return less than your required rate of return. This required rate of return is most likely in most cases the rate of return that you have to, or the rate of interest that you have to pay on money that you borrow to put into the project. Right? Let's look at a work example. Denny Associates has been offered a 4-year contract to supply the computing requirements for a local bank. The cash flow information, cost of computer equipment, 250,000, working capital required, 20,000, upgrading of equipment in 2 years, 90,000, salvage value of equipment in 4 years, 10,000, annual net cash inflow, 120,000. So this is an annuity here. Every year you're going to get this 120,000. Okay. All the others, the cost of the equipment is outflow. The working capital required, outflow. Upgrading the equipment in 2 years' time, that's an outflow as well. The salvage value, this is what you can sell it for after you finish the investment. It is an inflow, the net cash inflow, right? The working capital would be released at the end of the contract. Then the associates required 14% return. So this is what we will be looking up in the tables to get the discount factors. What is the net present value of the contract with the local bank? And the multiple choice question, this should be coming after, right? So we have the investment in the bank. Now that taking place at the beginning of the investment, we said. Sometimes you'll see year 0 here, 14 interest factor, 14%. In 1 year it will be 1, and the investment is in brackets to show you that it's an outflow. The working capital needed now 20,000. Again, the factor will be 1 because it's taking place now. It's an outflow. The annual net cash inflows 1 to years 1 to 4. We can do it this way since it's an annuity, and add up all the factors from year 1 to year 4 together, and we'll get 2.914. That gives us 349,680. When we multiply the 120 by this, okay? From our maths, we know if we are going to multiply the same number by a number of numbers, we can add all together and add them up, add up the numbers and multiply by the same number. Upgrading of equipment 2, we get 90,000, and it's an outflow. That taking place in the second year, at the end of the second year, so we multiply by 0.769. The factor was the second year, 69,210 would go out in that year. The salvage of the equipment at the end of year 4, 10,000 when we sell it, and we get 5,920. The working capital release 20,000, we get 0.592. Year 4 factors taken from tables, multiply them out, we get these two. The net present value, when we add down this column here, it's positive, right? Okay, the circle here is in the wrong place. It should be at B, right? Okay, that's happened because it's on full screen. But this figure is the one that goes here. It should be around the B. Okay, so that's how you get the net present value, and you check it right away. If this is positive, go ahead with the investment. So you can go ahead with this investment here. If it was negative, you will not So that brings us to the end of the lesson for today. Hope you find it helpful. If so, you would want to give it a thumbs up. If not, you can give it a thumbs down, and I'll see you in the next video.